Then we get to commandment number 4. Thou shalt look for hidden PE of 1 stocks. And so, here's the way the world works. So maybe there are around, let's say, 50,000 publicly traded companies globally. And let's say I set up a screen which said I want to look at all companies that trade at 40 times earnings or less. The odds are I'd have kind of tens of thousands of businesses that would fit that screen. If then I change that to a PE of 30, I'd still have, several thousand businesses. PE of 20, still several thousand. PE of 10, still maybe, north of 1,000, maybe well above that. And as I keep tightening that noose, to PE of 5, PE of 3, PE of 1, there will still be some businesses that will slip through. Now, those are the non-hidden PE of 1s. But what we want to look for is the hidden PE of 1s, which means they are a PE of 1, but they don't show up as such on a screen. So, for example, and they can be a PE of 1 based on future earnings. They may not be a PE of 1 on today's earnings. I mean, in 2012, when I invested in Fiat Chrysler, it was trading at less than $5 a share, and the company had forecasted that in a few years, actually 2018, that they would make about $5 a share. And actually, as we are coming into 2018, they spun off Ferrari. But if I include the whole pie, including Ferrari, they exceeded that number. So what we paid in 2012, PE of 1, materialized in 2018, and so the end result is that investment went up 7 or 8x in that period. So generally speaking, when you do PE of 1s, in general, good things happen to you. And another stock I think I'd mentioned in your class, Arvind, a few years back was IPSCO. It was a steel company. And at the time I was investing in IPSCO, I think it was 2004 or thereabouts, 2004, 2005. And IPSCO was trading, if you just screened it, it was trading at 3 times earnings. But 1/3 of the market cap was in cash. And so if you kind of adjust it for the cash, because they were trading at 2 times earnings, and the earnings in the next 2 years with the company's own guidance and such was what the company expected to make in cash flows in the next 2 years. And so basically you had a third in cash and in the next 2 years earnings coming out, and there was absolutely no visibility beyond the 2 years. So this was a very cyclical business. It was possible that after 2 years, earnings would just fall off a cliff. But my thinking then was that if we held the stock for 2 years, we got all our money back. And at that point, I just wanted to see what the stock would trade at. It had to trade for something because it had all these huge plants and infrastructure and everything else. And so what happened in that case is a year after I bought the stock, the company announced they had 1 more year of visibility and earnings were going to continue the way they had been happening, which means now we had, in effect, 3 years of visibility. So we were in the black. And then as we were getting close to 2 years, someone came and bought the company. And we ended up with about a 4x return on the initial purchase in less than 2 years. And so anyway, the PE ones, what I noticed is that in the last 19 years or so that I've been running Pabrai funds, it's happened at least 6 or 7 times that we found PE ones like Fiat Chrysler or like IPSCO. Very early on, I'd invested in Stewart Enterprises, which was in the funeral services business. That actually was sitting at a PE of 2 in Value Line. I opened up Value Line as I do every week. I always look for the PE ones in Value Line. Usually they're not there, but you can find PE of 2s quite commonly. Usually those are businesses that are good to avoid. But every once in a while, there is a gem that shows up. So, for example, the reason I was kind of interested in Stewart Enterprises when it showed up is that they're in the business of burying dead people, and they're in the funeral services business. And one thing I had read a long time ago about the funeral services business is that out of all the business SIC codes, industry categorizations, funeral homes have the lowest rate of business failure. So if you look at across industries, across a number of any industry, the lowest rate of business failure is funeral homes. And the reason for that actually becomes obvious if you think about it. So first of all, no one in this classroom, all of you gifted people, is planning to go into the funeral services business. I can almost bet on that. There are no 22-year-olds I know of who say, you know what, I think I'm going to go into the funeral services business because it has the lowest rate of failure. It's such an awesome business. That's what I'm going to do. Just doesn't happen. So first of all, the people entering the business are few and far between. And then the second is that when your aunt or uncle who you love so much passes away, you don't go about seeking the low bid to have their last rites done. You might at the most reach out to, typically you'll reach out to the place that ideally your family has been using for many generations, and hopefully get it done that way. But even if that's not the case, you'll try to reach out to some neighborhood funeral services operation, and whatever they tell you, you're not going to start negotiating on the phone, and you're probably not even making 5 calls to get the lowest bid. So this is not a business where you're going to seek out, unless you hated that particular relative, you're not going to particularly seek out a low bid. And of course, you've got all the upsells with air-conditioned coffins and everything else in between to make you feel really good. And anyway, so basically, the hidden PEO ones is really good for your health and your financial health. I mean, and so looking for them is a great exercise. And in fact, I just got back from Istanbul last night, and I think it was only PEO ones that I visited. I was swimming in PEO ones. It was quite the orgasmic experience. Anyway, so that's commandment number 4, to go hunting for PEO ones.